Why silver is way more risky than gold right now. Somewhere, in a quiet vault, a decision is being made that most silver holders will never see coming. The price charts look familiar. The pattern looks like every other rally before it. But this time, something underneath the surface has shifted, and the metal everyone trusted to move with gold is no longer playing by the same rules. There is a number, a single ratio, that economic historians watch quietly. And right now, that number is sending a warning, one that most stackers will only understand after it is too late to act on it. What is changing? Why is silver suddenly the more dangerous asset to hold? And what does gold know that silver does not? Stay with this video until the end, because the answer changes how you should think about your entire portfolio. If you are joining for the first time, thank you for trusting us with your time today. And if you are a regular voice in this community, it is good to have you back where you belong. Before we go further, may I ask something of you? If you have been with this channel for some time now, and you have found value in even one of these analyses, would you consider subscribing? Not for us, but for yourself, so that when the next warning comes, it finds you in time and not after. It costs nothing. It takes one moment, and it matters more than you might think. Now, tell us in the comments below, from which city, which country, are you watching this from today? This community spans the entire world, and we would like to know who is standing on the other side of this screen with us. With that said, let us begin. In financial markets, there is a quiet rule that few investors ever question. Silver and gold are supposed to move together. They are both metals. They are both stores of value. They are both seen as protection against uncertain times. For decades, this assumption has gone largely unchallenged. But analysts who study market history closely have started to notice something different happening this year. The old relationship between these two metals is no longer behaving the way it used to. And for those who have built their wealth strategy around silver, this shift deserves serious attention. To understand why, it helps to look at what actually happened earlier this year. Silver climbed to a high near $121 an ounce. Gold, around the same time, pushed close to $5,600 an ounce. Both metals were rising. Both seemed to confirm the same story, that investors were nervous and they wanted safety. Then, in early February, something changed. Both metals were hit hard, but silver did not just fall, it nearly cut in half. Gold, by comparison, held its ground far better. This was not a small difference, it was a signal. Many people who hold silver were confused by this. If both metals are safe havens, why would one collapse so much harder than the other? The answer lies in something that most casual investors overlook completely. Silver is not just one thing, it is two things, living inside a single metal. The first identity of silver is monetary. Throughout most of human history, silver was used as money. It was minted into coins, it was trusted, it was treated in many ways the same way gold was treated. This monetary identity still exists today. When investors are afraid of inflation, when they distrust currencies, when they look for a hedge against economic instability, some of them turn to silver for the same reasons they turn to gold. But silver has a second identity, and this second identity is the one that changes everything. More than half of all silver demand in the world today does not come from investors at all. It comes from industry. Silver is used in solar panels. It is used in electronics. It is used in electric vehicles, in artificial intelligence infrastructure, in the expanding network of 5G technology. This is not a small niche. This is the majority of where silver actually goes once it is mined. Gold does not share this burden. Gold has very little industrial use. Its value comes almost entirely from being trusted, stored, and held. Central banks do not buy gold because they need it for manufacturing. They buy it because, as one major European central bank has described it, gold functions as an anchor of trust. This difference may sound small, but it creates a deep and dangerous split in how these two metals behave when the economy shifts. When industrial activity is strong, when factories are busy, when clean energy projects are expanding, demand for silver can rise quickly. This can push silver's price upward, sometimes even faster than gold. This is the side of silver that excites investors. This is the side that makes headlines. But there is another side. When economic growth slows down, when recession fears rise, when factories pull back on orders, industrial demand for silver can weaken just as quickly. And when that happens, silver's price can fall sharply, even if investors are still nervous and still looking for safe assets. Gold, in that same moment, often holds steady, because gold's value was never tied to factory output in the first place. This is the disconnect that frustrated so many silver holders earlier this year. They watched gold rise to new highs while silver struggled to keep pace. They watched the gap between the two metals widen, even though both were supposed to represent the same kind of safety. This single fact, that silver carries two competing identities inside one market, is the foundation of everything that follows in this analysis. It explains why silver moves harder, faster, and more unpredictably than gold. It explains why silver can deliver extraordinary gains in one season and devastating losses in the very next. And it raises a question that every serious investor must now confront. If silver's industrial identity is becoming more dominant in today's economy, what happens to silver the next time global growth slows down? The data suggests an answer, and it is not a comfortable one. To understand why silver behaves so differently from gold, one must look beyond price charts and into the structure of the markets themselves. The numbers reveal something that most casual observers never consider. Silver and gold are not just different in purpose, they are different in size. And size, in financial markets, changes everything. The gold market is enormous. Estimates suggest it is somewhere between 10 and 16 times larger than the silver market. This is not a minor statistical detail. It is one of the most important reasons silver swings so violently, while gold tends to move with more discipline. Picture two pools of water. One is a vast lake. The other is a small pond sitting just beside it. If a person throws a stone into the lake, the ripple spreads out and fades quickly. The lake absorbs the disturbance with ease. But if that same stone is thrown into the small pond, the water reacts violently. Waves rise. The surface churns. The disturbance is impossible to ignore. This is, in essence, what happens when capital moves in and out of gold versus silver. Because the silver market is so much smaller, the same amount of money entering or leaving it creates a far greater impact on price. A wave of buying that would barely move gold can send silver surging. A wave of selling that gold could absorb without much damage can send silver crashing. This explains why, during the recent collapse in February, silver fell so much harder than gold. It was not necessarily that fear was greater for silver, it was that the market itself had far less capacity to absorb the selling pressure. Silver simply does not have the depth, the liquidity, or the trading volume to cushion sudden shocks the way gold can. There is a second factor that compounds this problem, and it has to do with how silver is actually produced. Unlike gold, which is mined primarily for its own value, silver is frequently a byproduct of mining other metals entirely: copper, lead, and zinc. This means silver supply does not respond quickly to changes in demand. If silver prices rise sharply and investors want more of it, mining companies cannot simply increase silver output on command. Production is tied to decisions made about entirely different metals, for entirely different reasons. This creates a strange and dangerous imbalance. Demand for silver can rise rapidly, driven by industrial growth or investment panic, while supply remains rigid and slow to adjust. When demand and supply move at different speeds, the result is almost always increased volatility. Prices do not adjust smoothly. They lurch, sometimes upward with startling speed, sometimes downward just as fast. There is also a third layer to this story, one that lives not in mines or factories, but in the trading floors of futures markets. A significant portion of silver's price discovery does not happen through physical buying and selling at all. It happens on paper, through contracts and speculative positions. Because participation in these markets is so heavily driven by sentiment, silver prices can become disconnected from the slower, steadier fundamentals of supply and industrial use. A wave of speculative buying can inflate prices far beyond what physical demand alone would justify. A wave of speculative selling can do the opposite, often with brutal speed. Gold experiences this too, but to a much lesser degree, because gold's deeper market and broader base of institutional and central bank participation tends to absorb speculative swings more effectively. Silver, smaller and more thinly traded, has no such cushion. When these three forces are combined, a market a fraction of gold's size, a supply chain that cannot respond quickly to demand, and a trading environment heavily influenced by speculation, the result is a metal that is structurally engineered for volatility. This is not an accident of sentiment or a temporary phase. It is built into the very architecture of how silver is mined, traded, and priced. For the casual observer, silver and gold may appear to be twin assets, two sides of the same precious metal coin. But beneath the surface, they operate in fundamentally different financial environments. One trades in a vast lake of liquidity. The other trades in a far smaller pond, vulnerable to every stone thrown into it. This raises an urgent question for anyone holding silver today. If the structural forces driving volatility have not disappeared, and if anything may be intensifying, what does this mean for the next major shift in the global economy? The answer lies not in past performance, but in understanding exactly what kind of asset silver truly is, and what kind of asset it is not. There is a number that few people outside professional trading desks ever pay attention to. It is called the gold-to-silver ratio, and it quietly measures how many ounces of silver it takes to equal the value of 1 ounce of gold. For most of recent market history, this ratio has hovered in a fairly predictable range. But during the recent surge to record highs in both metals, something unusual happened. The ratio never fell below 44-1. This may sound like a minor technical detail. It is not. Historically, when both metals rally together in a strong bull market, the ratio tends to compress significantly, often falling well below that level, as silver outpaces gold's gains. The fact that this did not happen this time suggests that the relationship between these two metals may be entering a new phase, one that long-term silver holders have not fully priced into their expectations. To understand why this matters, it helps to compare the two metals not just by price, but by what each one fundamentally represents to the people and institutions that hold them. Gold, above ground, is estimated to be 7 to 9 times rarer than silver. The mining ratio between the two metals sits at roughly 7 or 8-1. This scarcity is not just a geological fact. It shapes how gold is perceived and used by the most powerful financial institutions in the world. Central banks do not accumulate gold for industrial reasons. They accumulate it for one purpose: trust. One major European central bank has publicly described gold as an anchor of trust, a phrase that captures something important about how the world's most cautious financial institutions view this metal. Gold is not bought to be used. It is bought to be held, indefinitely, as a foundation beneath everything else. Silver has never occupied this exact role, at least not in the modern era. While it carries monetary history and some safe haven appeal, its identity has become increasingly intertwined with industrial necessity. And industrial necessity, unlike institutional trust, is sensitive to economic cycles in ways that gold simply is not. This distinction becomes critical when thinking about what happens during periods of economic stress. When fear enters the market, central banks and large institutional investors tend to increase their gold holdings, reinforcing its role as a stable hedge. Silver does not receive this same institutional backing at scale. Its price movements are influenced far more by a mixture of speculative trading, industrial demand fluctuations, and retail sentiment, three forces known for amplifying volatility rather than calming it. This is why serious analysts increasingly view gold and silver not as twin assets, but as fundamentally different instruments that happen to share a category. Gold behaves like an anchor. Silver behaves like a barometer, reacting sharply to shifts in industrial activity, economic confidence, and speculative appetite. For long-term wealth holders, this distinction carries a clear implication. Silver should not be approached with the same expectations as gold, particularly during periods of economic uncertainty. Where gold tends to provide a stabilizing force within a portfolio, silver introduces a layer of unpredictability that requires a different kind of preparation and patience. This does not mean silver should be dismissed. Its industrial relevance is, in many ways, a sign of its growing importance in a modern technology-driven economy. But importance and stability are not the same thing. An asset can be increasingly relevant to economic activity while simultaneously becoming more exposed to economic downturns. This is the uncomfortable truth that the gold-to-silver ratio is quietly revealing. The relationship between these two metals is shifting, not because investors have changed their minds, but because the underlying forces driving each metal have grown further apart. Gold remains anchored in trust. Silver is becoming more anchored in industrial dependency. And as global economic conditions continue to evolve, this growing divergence raises an important question. What happens to silver specifically when industrial demand itself comes under pressure, not from a single bad quarter, but from a broader economic slowdown that no one has fully prepared for? Every serious analysis of risk eventually arrives at the same question: what happens next? For silver, the answer depends almost entirely on one variable that most casual investors rarely examine closely: the health of the global industrial economy. Throughout this analysis, one fact has remained constant. Silver is no longer simply a monetary metal that moves in tandem with gold. It has become deeply tied to manufacturing, clean energy expansion, electronics production, and emerging technologies such as artificial intelligence infrastructure. This industrial dependency has been a source of strength during periods of growth. But strength built on economic expansion carries an unavoidable vulnerability. It weakens the moment that expansion slows. This is the scenario that economic historians watch most closely. If global growth decelerates, if recession risks increase, or if manufacturing activity contracts, industrial demand for silver does not simply soften gradually. Historical patterns suggest it can weaken sharply, and silver's price can fall just as quickly, even while broader fear is pushing investors towards safe haven assets in general. This is the disconnect that has already frustrated holders once this year. There is little reason to assume it cannot happen again, particularly if the conditions that caused it remain unresolved. Gold does not carry this same vulnerability. Its value is not dependent on factories running at full capacity or solar panel production accelerating. It is dependent on confidence, scarcity, and institutional trust, three forces that tend to strengthen, not weaken, during economic uncertainty. This is precisely why central banks continue to treat gold as a foundation asset, while silver remains, by comparison, a more reactive and unpredictable instrument. None of this suggests that silver should be abandoned. Its long-term relevance in a technology-driven global economy is unlikely to disappear. But relevance and stability are not interchangeable qualities, and recognizing this difference is essential for anyone making serious decisions about how to allocate their wealth. For those who choose to hold silver, this analysis points toward a clear principle. Silver should not be approached as a short-term investment vehicle, given how exposed it is to speculative trading and rapid sentiment shifts. It is far better understood as a long-term store of value, one that requires patience, discipline, and a tolerance for volatility that not every investor possesses. This is also why many experienced market participants choose not to treat gold and silver as substitutes for one another, but as complementary holdings. Gold provides the ballast, the stability, the anchor of trust that holds steady when uncertainty rises. Silver provides exposure to industrial growth and long-term monetary history, but with a volatility profile that demands a longer time horizon and a calmer mindset. The data examined throughout this analysis, the shrinking market size relative to gold, the rigid and slow-moving supply chain, the heavy influence of speculative trading, and the widening gold-to-silver ratio, all point toward the same conclusion. Silver's risk profile is not a temporary anomaly. It is structural, built into the very nature of how this metal is mined, used, and traded in the modern economy. For business leaders, entrepreneurs, and serious wealth builders, the lesson is not to fear silver, but to understand it accurately. Mispricing risk in any asset class is how fortunes are lost. Understanding risk, even when it is uncomfortable, is how fortunes are protected. The question that remains is not whether silver will move sharply again. History suggests it will. The real question is whether those holding it will be prepared when it does.